Right, next we have a clip on Biztech Asia Media Market Watch, a discussion between host Brian Fernandez with guest Jessica Amir, market strategies at Saxo Capital Markets. A conversation of insight on regional markets as well as the performance. Let's take a look.
Jess, one of the things that I read into was also the fact that the RBA said that they would continue the pace of rate hikes. Now, isn't that worrying both for the two sectors that you talked about earlier, the property sector, where consumers, as you said, are under duress already, and of course, the banking sector, which is exposed, which has a significant book in Australia and exposure to the property sector?
Yeah, absolutely. It is a huge concern. For those that don't know watching this, our Aussie share market is made up of predominantly commodities, which are doing well of late on the back of optimism that China will reopen essentially, with some of the largest capital cities easing restrictions of late. So that's why we're seeing iron ore and copper companies make cracking gains. However, if we touch on the banking aspect, yes, it's really worthwhile to point out that Australia's biggest banks and the smaller regional banks have been reporting a decreasing margin. So usually banks make more money when rates rise, but in this phenomenal period, we do have exceptionally high, and the RBA said the word painfully high inflation, and that is a concern when we have Aussie households that are the most highly leveraged households in the world with the highest debt to income ratios. There is a real concern that the property market could collapse, and that the big banks that many people are dependent on for their dividends, I'd say more perhaps old school investors, that the big banks will come under further financial strain and see sharp pullbacks next year in their share prices.
Now, just looking ahead now, we've got the Reserve Bank, the Fed Reserve Bank, basically with their rate decision next week. What else should we be watching out for that could move markets?
Well, I think the biggest concern right now is there is pretty much more headroom for the Federal Reserve to continue to hike rates. We know next week the market has priced in a hike of 0.5%. However, we're really looking for clues that the Federal Reserve can continue with its pace of hikes. Overnight in the US, we saw that the services sector is stronger than expected. The services sector, really important to the US, 70% of their GDP comes from the consumer. So this is basically, a flag saying the Federal Reserve can continue with its pace of hikes, given inflation there is still high, well above the Federal Reserve target. Now, the risk for this, going back to your question, the real risk is that PE stocks, those really high PE stocks, I'm talking tech stocks now, specifically in the NASDAQ, they are looking prime for a potential pullback. So thinking about the NASDAQ, the average price to earning ratio of a stock in there is 40 times. That means you've got to pay for it 40 times before you can even think about getting earnings. And now the market is, I guess, toying with higher for longer rate hikes. Rate hikes are here to stay, but also slowing down of consumption. So we're likely to see a potential recession, and that means that the EPS that the market is looking at, the earnings per share, might not eventuate, and so we could potentially see another very sharp pullback for the NASDAQ. So investors might like to think twice about their positions in tech, maybe potentially take some profits or look at writing downside protection using options. So there's a lot of risk still on the table. The next catalyst, this Friday's producer prices, but then, of course, looking to next week's decision from the Fed, the final one from the year. So a lot is on the line.
Jess, thank you very much for coming on the show. Thanks a lot for your insights.
Thank you so much, Brian.